Welcome students to another lecture in the series, Greetings of the Day. We are studying Unit 4, that is Marginal Costing and Profit Planning. Let us move ahead with the next topic. It's an important topic, Cost Volume Profit Analysis. As the name is only suggesting that it is an extension further where you will be able to check out the level of cost, volume and profit. It is an extension of principles of variable costing only. It means that the principles which are derived and applied in variable costing are also applicable here. So every company, let's see and understand this as an example. Every company must earn profits to stay in business. So CVP helps the management in profit planning. Cost, volume, profit planning, that how much cost is being invested, how much production volume is there, and how much profit is being earned of it. Managers make various plans to increase company profitability, like how the profits will be affected if an additional sales promotional expenditure of rupees 2 lakh increases sales by 40,000 units. So similarly, like many more questions can be answered, like how many units of products should be sold to earn a profit of rupees 2 lakh 50,000. If company sells 1 lakh 50,000 units, what would be the amount of profit? So these are some similar questions which we can easily answer using this CVP ratio. Here, this analysis studies the interrelationship between the three basic factors of your business operation, that is your cost of production, volume of production or sales, and the profit. The three factors are interconnected in such a way that they act and react on one another because of cause and effect relationship amongst them. The cost of a product determines its selling price, and the selling price determines the level of profit. The selling price also affects the volume of sales, which directly affects the volume of production, and volume of production in turn influences the cost. So we can say variations in volume of production results in change in cost and profit. As per CIMA, this analysis can be defined as the study of the effects on the future profits of changes in fixed cost, variable cost, sales price, quantity, and mix. Okay, further, an understanding of this analysis is extremely useful to the management in budgeting and profit planning. So basically, it explains the impact of the following on net profit. Means the impact of change in selling prices on net profit. Similarly, changes in volume of level, changes in volume of variable cost, changes in volume of your fixed cost on the net profit. In fact, this helps in determining the probable effect of change in any one of these factors, even on the remaining factors. Then we have break-even analysis. This is a widely used technique to study cost volume profit relationship, and it is interpreted in narrow as well as broad sense. Let us see how narrow sense. In its narrow sense, it is concerned with determining the break-even point, means the level of production and sales where there is no profit, no loss situation at par. So at this point, total cost is equal to total revenue, so there is no profit and no loss. And in broader sense, it is used to determine the probable profit or loss at a given level of production or sales. It also helps in calculating the amount or volume of sales to earn a desired amount of profit, which is an important aspect that each and every company would look forward. Now let us see on what assumptions this break-even analysis or CVP analysis works on. It works on 8 assumptions. All costs can be separated into fixed and variable components. Variable cost per unit remains constant, and total variable cost varies in direct proportion to the volume of production. Total fixed cost remains constant. Selling price per unit does not change as the volume changes. There is only one product, or in the case of multiple products, the sales mix does not change. In other words, when several products are being sold, the sale of various products will always be in some predetermined proportion. There is synchronization between production and sales. In other words, volume of production equals volume of sales. Productivity per worker does not change, and there will be no change in general price level either. Further, contribution and marginal cost equation. As we have already explained, that contribution is the difference between sales and marginal or variable cost of sales. So it is known as contribution of margin or gross margin. So this we can calculate it using any of these formulas: sales minus the variable cost, or fixed cost plus the profit, or fixed cost minus the loss. So from this we can have this equation that your sales minus variable cost will be equals to fixed cost plus the profit. So if any three of the above factors in the equation are known, so fourth can be easily calculated using the other three. Let us see this through an example. Suppose sales is 12,000, variable cost is 7,000, fixed cost is 4,000. So we can calculate the contribution: sales minus your variable cost, that is 5,000, or the other way around, we can calculate it. That we can calculate the profit, that is contribution minus the fixed cost. So that is 1,000 here. If the sales figure is not given, suppose, but contribution is given, when the sales can be determined using this formula. Like we can have it by contribution plus the variable cost. Okay. When fixed cost is not given but profit is given, so we can calculate fixed cost equals to contribution minus the profit. And when variable cost is not given, then we can calculate it using subtracting the other two. So it is helpful in calculating or studying the break-even analysis and taking the management decisions. Let us see. We need to calculate fixed cost and profit. We can simply add them and find out the contribution. Then variable cost and sales, we can subtract them and find the contribution. And the last case, you can see contribution per unit is given as rupees 7. Then profit is 3,000. Break even point is 2,000 units. So break even point into the price plus the contribution. So contribution per unit. Okay. So that is 17,000 is the contribution. Now let us see profit volume ratio, or PV ratio, better known as contribution sales ratio even, and can be expressed symbolically as PV ratio equals to contribution upon sales, that is C upon S, or simply S minus V upon S. By transposing, we can calculate the other two formulas even like this, that your contribution is equals to your sales into the PV ratio, or sales is equals to contribution divided by the PV ratio. We can study this using the formula. Sales is 10,000, variable cost is 8,000. We can use any of these formulas and find it out, and it is coming out as 20%. Okay, when PV ratio is given, contribution can be quickly calculated from any given level of sales. So in that example that we have studied in the previous slide, PV ratio was given, contributions can be calculated even like that. Now PV ratio may be computed by comparing the change in the contribution to change in sales. Any increase in profit will mean increase in contribution, because fixed costs are assumed to remain constant at all levels of production. So contribution, change in contribution upon change in sales can be calculated using this formula. So in this case, the PV ratio is coming out as 30%, because they have given the sales of 2009 and 10, and the net profit is also given. So we can subtract the changes and multiply it by 100 to obtain this PV ratio of 30%. Let's see this question. These are independent situations. Let us see on the next page. We can calculate PV ratio in the first case by dividing contribution by sales, and sales can be further replaced by variable cost plus the contribution, coming out as 40%. In next case, contribution upon the sales, that is your sales minus variable cost upon the sales, so 25%. Next case, variable cost to sales ratio is given, so we can find out it by subtracting. So its PV ratio 16%. In the next one, we can add up the fixed cost and the profit and find it out. In the next one, we can have the change in profit and change in sales and find it out. Then we have uses of PV ratio. We have studied that it is one of the most important ratios for a business to watch on, because it would help them to check out that what profit is being earned. So it's better to have a high PV ratio, because that indicates a high profitability, and a low ratio would indicate the low profitability of a business. The profitability of different sections of business, like your sales areas, classes of customers, product lines, methods of production, they all may be compared with the help of PV ratio, and it is used in making uh, many types of calculations. Like you can use it to calculate break-even point or profit at a given level of sales, or volume of sales required to earn a given profit, or profit when margin of safety is given, or volume of sales required to maintain the present level of profit if selling price is reduced. So it is having many uses, and it is a very useful ratio. Further improvement in PV ratio, as PV ratio indicates the rate of profitability, we know that very well. So any improvement in this ratio without increase in fixed cost would result in higher profits. Erroneous conclusions may not be drawn just by mere having a look at PV ratio, because this ratio should not be studied in isolation. It should be studied with other things as well. It is a function of sales and variable cost, and thus it can be improved by widening the gap between the sales and variable cost, by increasing the selling price or reducing the variable cost, or changing the sales mix, means selling those products more which have a higher PV ratio than by improving. Thereby, we can improve the overall PV ratio using these methods. Till then, study well. We'll continue in the next lecture. If you have any queries, you may write to me.